Have you ever wondered why ETF investing became so popular? In this video, I will break it down for you by giving my top 4 reasons why ETF investing works. The amount of cash invested in ETFs globally ballooned to $10 trillion over the past 20 years. Let's look at how ETFs work. Any ETF starts with its ETF sponsor. An ETF sponsor is an issuer and fund manager that administers and promotes its ETF. The ETF sponsor creates a trust company that will hold stocks from the underlying index. Next, the sponsor selects an index to track, such as S&P 500 or Nasdaq 100. The next step is creation of ETF shares. An ETF sponsor contracts with broker-dealers to create ETF shares on its behalf. These broker-dealers are large financial institutions called authorized participants. Their role is to regulate the supply of ETFs shares. The ETF creation occurs in the primary market. Think of primary market as a marketplace where shares are sold for the first time. Secondary market is where investors later trade securities on stock exchanges. First, authorized participants buy securities with proper weights to mimic the underlying index. The total value of assembled securities is measured in ETF creation units. The typical creation unit has 50,000 ETF shares. Thus, the authorized participants must buy enough securities to support 50,000 ETF shares for one ETF creation unit. Then authorized participants deliver the underlying stocks to the ETF sponsor. After that, the ETF sponsor issues and delivers new ETF shares to the authorized participants in the primary market. Later, these new ETF shares are introduced into the secondary market. This is where any investor can buy or sell them. The redemption is just the reverse of ETF unit creation. So, why ETFs became so popular? Let's unpack the reasons behind it. The reason number 1 is the trading flexibility and liquidity. Unlike mutual or index funds, ETFs can be traded as any other stock. Conversely, open-end mutual funds can be traded only after the market closes. It is true that buying or selling at the end of the day is okay for most long-term investors, but many people need more flexibility than that. Moreover, you can place limit orders on ETFs, you can use margin, you can short sale them, you can buy options and many other things. So many people prefer this flexibility of ETFs as opposed to rigidity of mutual or index funds. Reason number 2 is lower cost. Compared to mutual funds, ETFs do not incur many client service related costs and expenses. For instance, ETFs do not have to handle any client calls, or they do not have to send reports and periodic statements to its shareholders. Moreover, ETFs do not charge redemption fees and load fees that mutual funds are notorious for. The third reason is tax efficiency. Investors pay capital gains taxes only when they sell their ETFs shares, so they're in full control of the tax timing. Conversely, mutual funds often pass their capital gains taxes to investors, so many people get their year-end tax surprises from mutual funds. Diversification is my final reason number 4. Of course, diversification is not unique to ETFs, and similar to mutual funds, ETFs lets you get an exposure to a diversified basket of stocks or bonds, and in this case your fortunes will not be tied to just a few stocks. And this has a profound psychological implications, because if your ETF's price starts to go down, you are less likely to sell. Conversely, what if your portfolio is based on your stock pickings? Then you may freak out thinking you got it all wrong and sell everything. Selling at the bottom is the worst thing, and it happens often. For most people who have no time for stock research, ETF investing is the best and easiest way to go. Besides, ETFs allow you to invest in a wide variety of portfolios. For instance, those include international equity, bonds, preferred shares, emerging markets, or volatility. So investors can diversify their portfolio just with a click of a button during trading hours. On a final note, it's almost always a good idea to buy ETFs that track some broad stock market index. S&P 500 comes to mind. Or if you have at least 10 or 20 years to wait, Nasdaq 100 index is one of the best. I made a video where I laid out the reasons why ETFs that track Nasdaq 100 are one of the best investments for young investors. Investing in ETFs tracking some broad stock market index is like momentum investing. What do I mean by that? Well, take for example S&P 500. The committee for S&P 500 selects stocks based on market cap, financial performance, and liquidity. If a company underperforms, the S&P 500 committee will drop such stock from the index. And this approach to some extent mimics momentum strategy. It amplifies strong performance and suppresses weak returns. That is it for this video. I hope you learned something today. Please give it a like or dislike if you disagree, and leave me a comment why. Thank you for watching.